Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
In today's episode, you'll learn about, first, today's US market review. Alarm bells ring as the Nasdaq plunges 1.7% in a tech massacre. But while mega caps bleed, a massive capital rotation is underway. Is this the start of a market-wide crash? Second, Wall Street Titans issue shock warning. A 20% market correction looms, but their secret bet is on Asia. Goldman Sachs and Morgan Stanley are telling you to brace for impact. So why are they quietly pointing clients to a new global hotspot? We'll reveal the regions they believe will surge. Finally, AMD's OpenAI coup ignites chip war chaos, but Amazon's shocking stock dump reveals a hidden danger. AMD's revenue skyrockets 36% in a direct assault on Nvidia's throne. But why did Amazon just dump its entire stake? This move could signal a critical turning point for the entire AI market. Warning, the market's sending a danger signal today. Mega cap tech stocks are taking a hit, and the Nasdaq plunged 1.7% to 23,348, marking its steepest decline in recent weeks. I'm telling you, this is a tactical inflection point. Don't wait. Act now. Here's what's going on. The US stock market is undergoing a sharp valuation reset as concerns about inflated CAPE ratios and a shifting Federal Reserve interest rate outlook shake investor confidence. The S&P 500 dipped 1.2% to around 6,771, while the Dow showed relative strength with only a 0.5% decline. But beneath the surface, the breadth is collapsing. Only 38.6% of stocks advanced today, with decliners outnumbering advances by a wide margin. This narrow leadership is a warning sign, I'm telling you. It's time to reposition your portfolio. Let's dive deeper into the problem. The CAPE ratios are approaching levels reminiscent of the dot-com bubble, and with the probability of a December rate cut dropping sharply from 90% to 67%, the market is bracing for a higher for longer rate environment. This shift is creating a perfect storm for growth stocks, which depend heavily on low discount rates for their lofty valuations. In the policy realm, Federal Reserve Chair Jerome Powell's recent comments have spooked the market. By stating that the December rate cut is not a foregone conclusion, Powell has effectively slammed the brakes on rate cut expectations. With inflation still above target and employment risks rising, the Fed's cautious stance is a game changer. The 10-year Treasury yield has remained elevated at 4.13%, creating a headwind for long-duration equities and raising the implied cost of capital for growth companies. From a money flow perspective, this policy shift is prompting a rotation out of high valuation growth stocks into defensive sectors and bonds. The declining mega cap tech stocks, like Apple and Microsoft, are absorbing the selling pressure, while investors seek safety in value and dividend-focused areas. The fear gauge, VIX, is ticking up, indicating rising market anxiety. Valuation-wise, the tech-heavy Nasdaq is bearing the brunt of this correction, with mega cap tech stocks like Palantir and Nvidia experiencing sharp declines despite positive earnings. It's clear that the market is recalibrating risk premiums. Listen to me, this isn't just a blip, it's a signal to reduce exposure to overvalued tech and pivot towards sectors better positioned for a higher rate environment. Now, let's break down today's sector movements. The consumer discretionary sector gained 0.9%, buoyed by Amazon's strong performance. Amazon soared over 4% after announcing a major AI partnership with OpenAI, highlighting its strategic pivot into AI infrastructure. Meanwhile, the technology sector tumbled, with Palantir plummeting nearly 10% despite beating earnings expectations, a clear sign of valuation reset. In contrast, defensive sectors like consumer staples and utilities held firm as investors sought refuge in stability. The technology select sector SPDR, XLK and Nasdaq 100 QQQ are under pressure, while energy stocks face headwinds from falling oil prices. Good advice makes you rich, bad advice costs you a fortune. Listen to me, here's how you should act. Short term, 1 to 2 weeks. If the 10-year yield remains above 4.0%, cut tech exposure by 15 to 25% and rotate into financials, XLF plus 3 to 5%, and energy, XLE plus 2 to 3% today. Target Palantir, Tesla, and Nvidia for reduction as their high valuations are vulnerable. Medium term, 1 to 3 months. Use cash from these reductions to build positions in consumer staples, XLP, and utilities, XLU, for dividend stability in a volatile market. Defensive strategy. If the Nasdaq breaks below 22,500, hedge with SQQQ or buy QQQ. Put options to protect against further downside. For advanced investors, sell call spreads on Palantir to generate income. And for intermediates, increase cash allocation by 5 to 8% to maintain flexibility. Basic investors should focus on reducing tech holdings and increasing defensive positions gradually. Time's ticking. Let's dive deep into today's critical market dynamics. And remember, navigating these turbulent waters requires swift, decisive action. Two of the biggest names on Wall Street, Goldman Sachs and Morgan Stanley, just issued a direct warning to investors: brace for a market correction of up to 20%. A while back, we talked about the tension between a weakening power put and a powerful AI call driving this rally, and today's warning lands squarely in that gap. This comes as global markets are hitting record highs, fueled by an AI-powered rally that has sent key US indexes, Japan's Nikkei, and South Korea's Kospi to new peaks. However, if you zoom out, you'll see another layer of strategy at play here. The market's dependence on AI-linked gains makes it uniquely vulnerable. According to the Gartner hype cycle, generative AI has now entered the trough of disillusionment. This means the initial excitement is fading and companies face the hard reality of turning AI investments into profits. With so much value in a few big tech stocks, any disappointment could trigger the very pullback these CEOs are talking about. Are you following the thread? This is the key vulnerability to watch. Remember what we said before? Markets are great at pricing the next move, but terrible at pricing the next regime. Even as hype cools, the multi-year AI capital expenditure race set to accelerate into 2026 can keep the long-term story intact while prices reset. But just as the celebration started, Goldman Sachs CEO David Solomon went on the record stating, quote, "It's likely there'll be a 10 to 20% drawdown in equity markets sometime in the next 12 to 24 months. He added, "Things run and then they pull back so people can reassess." He wasn't alone. Speaking at the same panel, Morgan Stanley CEO Ted Pick said investors should welcome these pullbacks, calling them healthy developments. So what does a healthy correction actually mean? Well, what's crucial to grasp here is the difference between a correction driven by high valuations and a crash driven by collapsing profits. A healthy correction happens when stock prices get ahead of themselves, even while companies are still doing well. Analysts are still forecasting strong S&P 500 earnings growth of nearly 14% for 2026. Yet, the market's forward P to E ratio is at 21.9, well above its 10-year average of 18.4. That's a fascinating signal because it tells us that while companies are expected to make money, their stock prices already reflect that good news, and then some. That's why a pullback would be a reassessment of price, not a panic over the economy's health. Now, get this. These verbal warnings from the two financial titans echo recent cautions from the IMF and Fed Chair Jerome Powell about inflated valuations. This is a classic tactic called jawboning. The goal is to use public statements to gently cool down an overheating market without having to raise interest rates, which could slow the entire economy. It's a way of signaling caution. And as we've noted, the Fed can use guidance to lean against overheating without snuffing out AI-driven investment. But here's the twist in their guidance. They are not telling clients to sell. Their advice is to stay invested and review allocation, not time the market. Solomon himself noted that a 10 to 15% drop happens often and doesn't change the fundamental structure of how to allocate capital. It's the same message we've emphasized. Don't try to time the next move position for the next regime. So if a pullback is coming, where do these giants see opportunity? They're pointing east. Both firms highlighted Asia, with Morgan Stanley naming Hong Kong, China, Japan, and India. The situation presents a fascinating duality. In Japan, the excitement is about a decade-long push for corporate governance reform that's now attracting foreign capital. In China, the story is different. The focus on AI, EVs, and biotech is directly linked to its long-term industrial strategy, like the Made in China 2025 initiative. This is capital chasing strategic certainty, not just momentum. The message from the top is clear. The rally may be due for a reality check, but the long-term game is shifting to Asian markets as the next frontier. We were just talking about the big picture risks in the AI rally. Now, let's zoom into the trenches of the chip war where a major power shift is underway. Now, get this. AM just landed a blockbuster deal with OpenAI, the company that has relied almost exclusively on NVIDIA for years. In a move sending shockwaves through the AI world, OpenAI will not only deploy AMD's next-generation Instinct GPUs, but could also take a 10% stake in the chip maker. This is a direct shot at NVIDIA's dominance. So the thing is, when a market moves from a monopoly to a true second source, a few things happen. For big buyers like OpenAI, Microsoft, and Google, it de-risks their supply chain. For the chip makers, it often signals the beginning of real price competition, which could mean the peak of the astronomical profit margins we've seen from NVIDIA. Here's where it gets interesting. That 10% stake is a completely new kind of partnership. This isn't just a customer placing an order. It's a top AI lab taking an equity position in its hardware supplier. Why? To secure future chip supply and, more importantly, to influence the design of future chips. This could shift power from the chip designers to the big AI labs, creating a more customized hardware market. And it doesn't stop there. Tech giant Oracle announced it's deploying 50,000 of AMD's new Instinct AI chips in its cloud, another massive win for the challenger. These strategic strikes are backed by some incredible numbers. AMD just reported revenue of $9.25 billion, a 36% jump from a year ago that crushed Wall Street estimates. The company's data center business surged 22%, but the real explosion was in its gaming segment, which skyrocketed an incredible 181%. Interestingly enough, this shows the story isn't just about AI. That 181% jump in gaming, along with strong PC chip sales, suggests a broad cyclical recovery in consumer hardware is finally underway. The post-COVID slump appears to be ending, which is also good news for companies like Intel and Dell. But what really brought this to a head was this crucial piece of the puzzle. Despite the massive revenue beat, AMD's profit margin guidance was just in line with expectations. After all, competing with a giant like NVIDIA is incredibly expensive. It challenges the narrative that any company entering the AI chip space can easily achieve, NVIDIA's legendary 70% plus gross margins, and forces a reevaluation of long-term profitability for the whole sector. But just as the bulls started cheering, a bombshell from an SEC filing dropped. Amazon, a key cloud customer, quietly dumped its entire stake in AMD, selling all 822,234 of its shares just before this blowout quarter was announced. The move raises serious questions about what one of the world's biggest tech players sees that others might be missing. Given the trend of hyperscalers diversifying suppliers, this also fits a broader pattern of strategic hedging. Even with that twist, the market is electrified. AMD's stock has already soared over 100% this year. The company is now forecasting 25% growth for the next quarter, signaling its assault on the AI chip market is just getting started. The battle for AI supremacy is officially on. The key focal point now will be to watch if AMD can translate these major wins into sustained market share gains from NVIDIA. Investors will be tracking gross margins in the coming quarters. If AMD's presence forces NVIDIA to lower its prices, we could see pressure on the stock valuations of the entire semiconductor sector. Ultimately, this isn't just about one company's success, it's about the profitability of the entire AI hardware boom.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.